What's going on, everyone? Welcome to another episode of The Remote Investor. I'm Michael Album, and today I'm joined by my good friend, Dan Frio, who is a mortgage advisor, and he's going to be talking to us about all the things we need to be considering if we're even contemplating a mortgage refinance. So let's get into it. Dan, good to see you again, man. How are you?
I'm doing awesome, man. Thanks for having me. It was so cool. How you found me. So I just want to be transparent. I do similar things to you. I watch people on YouTube and I'm like, hey, they would be a great guest, or that'd be a great debate. And you probably do the same. I'll email 50 people and you'll have 2 or 3 respond. And those are the doors that open. That's like, okay, this is awesome. So thanks for shooting me an email. And anytime you need some, intake on mortgages and stuff like that, reach out to me. I'd love to help.
Thanks, Dan. I really appreciate it. And I like you said, it was a totally cold email. I reached out and you couldn't have been warmer. You couldn't have been more receptive to it. So I said, this is somebody we definitely have to have on here. So I am thrilled to have you. Super excited to do this. So Dan, for anyone that doesn't know your background, maybe not familiar with your work, give us a quick and dirty 30 seconds, who you are, where you come from, and what is it that you do?
Yeah. So my name is Dan Frio. If you follow me on YouTube, if you don't, you never heard of me. It's the Rate Update on YouTube. I've been in the mortgage business 35 years, and I write loans every day. So I'm not a YouTuber out there that just kind of gives you kind of what might be going on. I actually know, I've been in this business. I've owned my own brokerage. I've underwritten. I've been in sales. I've been in all aspects of this. And that's what I do. I'm originally from a small town in West Virginia. Got a degree in economics. I had $3,000 in the bank. I bought a car and moved to Chicago to try to get in the board of trade. I couldn't. And then I got stuck doing mortgages the rest of my life. And that's where I am today.
Awesome. Well, that's exactly what I want to talk to you about today.
Sure.
And specifically when it comes to refinances. So it's no surprise when you and I are recording this, we're in the middle of a pretty high interest rate environment. So the fact that you've been in the industry so long, I would love your perspective on where are we in terms of interest rate highs, lows, mediums? I mean, in the grand scheme of things, are they high? Just set the stage for us.
Sure. Well, you have to really know kind of history when it comes to this. So I'll say rates are high relative to what? Okay, so if you go back in history, and I've been doing this a long time, I don't have much gray hair up here, but I got a lot here. I'm almost 60 years old. So I've been doing this a long time, and I've seen all the cycles come through. Historically, and this is where people will say, oh, you're too old. But historically, rates are usually 6, 7, 8%. So that's the norm. And you should normally see appreciation on homes at 3, 4, 5%. It depends on where you live. But you have to kind of rewind and see, where did we go? How did we get there? So when COVID hit, what happened was basically the world shut down. Okay, so you have to figure out why rates went to where they are to kind of figure out where they're going from here. So what happened was the Federal Reserve, they don't control mortgage rates, but they can kind of entice what they're going to do. And here's what I mean. Mortgage rates are tied to a bond, all right? So what happened was the Fed came in and they were buying $40 billion worth of bonds a month, and they were driving the prices skyrocketing, the mortgage bond prices, because they kept bidding and bidding higher and higher prices for these. Well, as they're buying these bonds, as the prices go up, yields come down. So we basically saw the lowest rates ever in history. I refinanced my house at 2.625 on a 30-year fix back a couple years ago. So we're probably, I'll put it this way. I hope we never see those rates again. And the reason being is, how did we get there? Well, the world shut down and the governments and everybody had to come in and step in and do something before the whole world imploded. So that's what kind of put us to this, where we are today. So now we saw inflation. I called this 2-3 years ago. I'm like, with the federal government pumping all this money into the money supply, you're going to have inflation. And I had a lot of people just tell me I was crazy at the time. They wouldn't have me on their channels anymore. So I'm like, okay, well, we'll see. And then you saw inflation jump to 9%. Okay, so
and they were like, Dan, come give us a postmortem. Yeah. Come be on my show.
Yeah. So now what we're seeing is the Federal Reserve raised rates, I think, 11 times in the last 2 years. And now it's finally starting to work. And prices are coming down, not on services, but on a lot of other things. So the inflation front's starting to come down. So now there's a whole bunch of dynamics on where rates are going to go from here and so forth. So here's the problem. The Federal Reserve, all they control is one rate. It's called the federal funds rate. Okay, they don't control mortgage rates. They don't really control rates. It's just the federal funds rate they control. And that's basically tied to a lot of short-term maturity things like, car loans, credit cards, things like that. Mortgage rates are tied to a bond. And we went back to, the Federal Reserve is the ones that really dropped those yields on those bonds to unprecedented levels that we've never seen. So then, that kind of bit us in the ass, and then rates jumped up, and then now they're starting to cool down. So I just did a video this week. I posted it. And the tough thing now is trying to figure out, where do we go from here? Okay, so what's going to happen, though, is the deficit is playing a bigger role in this than a lot of people think. So I'm not trying to stretch out this answer, but you have to understand how mortgage rates work. Okay, so mortgages, like I said, are a bond. But if you pay attention to the national debt, and you might be too young, when I was your age, I never really gave a shit about the national debt. We'd hear about it every election, and they'd say it's out of control, and you're looking at it, it's like, but now it's $35 trillion, $35 trillion. And what a deficit is it's basically the Federal Reserve doesn't have that much money to pay their bills. So they issue Treasury bills like we use our credit cards, okay? So there's $37,000 in debt that the federal government can't really pay, so they finance this with bonds. What happens is they flood the market with all these bonds. Like this week, there was over $125 billion worth of bonds that came to auction. And a lot of investors aren't buying these because there's too many bonds by the Treasury being issued because of the deficit we have. And then you have corporate bonds that mature every year. And then you have mortgage bonds that, when people get a mortgage, that's a new bond that's created and goes into this environment. So you have a flood, a massive amount of bonds hitting the market, okay? So it's like the housing crash of 2008. Why was there a crash? Well, you can debate the reasons behind it, but what happened is too many people went into foreclosure because of subprime mortgages. So you had a massive amount of homes hitting the market. When you have a massive amount of anything, you have a massive amount of homes hitting the market, well, prices are going to drop. If you have a massive amount of bonds in the market, prices are going to drop. Well, what happens with yields on things is prices of bonds go down, yields go up. Okay, so now you can see a flood of bonds in the market is going to push down the prices. When the prices go down, yields go up. Okay, so what's happening right now, mortgage rates usually have a spread of about 150 to 200 basis points from the 10-year Treasury. So if you ever ask anybody kind of years ago, what's mortgage rates? They'll say, well, what's the 10-year Treasury? Just add 1.5% to that, and that's your mortgage rates. Well, the spread is about 2.5% right now. The norm is 1.5% to 2%. And again, we're at 2.5%. That the reason why there's an excess spread there is there's much more risk and there's too many bonds in the market. So now getting to your question, rates should be the 10-year Treasury right now, which is 3.93, I think, plus about 2%. So that would be rates should be about 5.93. Well, rates today are about 6.5 or 6.6. So you can see where there's an excess spread there that shouldn't be there. So generally rates today should be about 5.75 to 6%, but they're 6.5. So where they're going to go from here, I'm going to have kind of defer to the Fed because the Federal Reserve has all control right now of basically everything. And you can see, based on the recording of this event, Monday we had a big event that happened. It was called the carry trade. And the carry trade caused huge havoc in the market. And then all of a sudden people are like, oh my God, we're going into a recession and this is going to happen. And the Federal Reserve now needs an immediate emergency cut. And then we found out, 48 hours later, it was a carry trade that was unwinding, and now everything's kind of back to normal. So there's huge hiccups in the market right now. Rates should be about, right around the 5.75, 6% mark, but they're a little bit higher, and they're probably going to stay that way as long as the federal deficit is just screaming out of control. I'll stop there because I have probably most people either confused or bored to death. It's not an easy question to say, okay, they're going to come down. I want you to understand why. Because so many people come online and they're like, oh, the market's going to crash. Because 2008, we had a huge run up in values and it was unsustained, so it crashed. So it has to happen again. And I'm like, that's not a good argument. Just because something goes up doesn't necessarily mean it has to come down. Look at the stock market. You look at the stock market over from 1960 to today, it went up. Did it ever go back down to where it was in 1960? No. So that's kind of my what's going on there. But you have to continue to monitor, what the Fed's going to do. We have an election year. We have, the world's a mess. What used to happen, when we had times of uncertainty, like we have a Russian, Ukraine war, we have Gaza, Israel, China and Russia's flying over the Antarctic and things like that. We're catching them in planes. Usually what happens is you'll see the stock market basically just crash, and you'll see people, what they'll say is they'll move their money to safety, a safe haven, and safe havens are usually bonds. But right now, nobody wants bonds because there's just too many of them, and it's really hard to buy. So hopefully that kind of ties that up a little bit for you.
Dan, we should have, I wish you would have given us a disclosure. Me personally, it says, Michael, put on your helmet because I'm about to explode your head here with some of this background information. I love it. And I think you're right on the money with giving people the explanation as to the why and not just the how. But so I'm curious, you mentioned this extra spread, this extra half-point spread above and beyond where you said interest rates, quote unquote, should be. And you said that's probably going to stay there for a while. But can we come back to what's driving that? Is it the national debt? Is that the only thing?
Yeah, there's just too much debt out there right now, and that's a concern. There was a bond. I follow bond auctions too. I know I'm a nerd, but I look at this. My whole business is mortgages, and it's all tied to interest rates and things like that. I don't know what's going to go on with house prices because you guys are in California. Your prices might be crashing. They might be doing what they're doing. Here in Chicago, I just got an analysis on my house just over the weekend, and I did a video on it. And my house, my whole neighborhood's up 7.8% over year. So we usually don't even see 7%. We'll see 3, 2, something like that. So we've never seen, the 20% gains that people see. So, in our market, it's still okay. In a lot of markets, it's still, we didn't see that huge spike as a lot of places saw. So now you have a lot of people going out there and saying, they'll this is where my pet peeve is in the crash stuff. Some areas are crashing, but you can't just generically say the whole world's imploding on itself because it's not. So my whole goal is to explain to you guys, what's going on and the whys behind it. So I try not to get into home prices other than to say, if somebody says the whole market's crashing, it's not. Okay. And that's what I want to get over to people. And so you have to do your own research in the areas that you're looking into specifically. Now, when will that, the excess kind of get absorbed out of there? Well, it's when things start to stabilize. And what stabilization is, I just listed a laundry list of things that's wrong right now. You have wars in Russia and Ukraine. You have Gaza. You have Israel. You have a deficit that's out of control. You have an election that's just a complete farce, and you have all this other stuff going on, and it's just like, that's the uncertainty built into the market. And I think mainstream media plays a lot into it as well, because you could just see from the crash that we saw on Monday, everybody's, saying we need an emergency rate reduction and things like that. And then by the end of the week, I think the market might even closed up higher than where we started, where we were last week. So, it's not like everything that happens, it's like the media just comes out and the house is on fire. And it's not. You have to just settle down and watch things as they go. But I'm not a proponent of, buying a house now because the rate's fantastic or not buying now because the rate is high. I look at it as my hope for people is long-term goals. Where are you going to be in 5 years, 7 years, 10 years from now? Maybe buying a house isn't in the cards for you today, but it's a part of an asset allocation that you really need at some point in your life, maybe. So, okay, I don't even know if I answered the question that you asked me.
You did. You totally did.
Okay.
But I want to dig into exactly where you left off, and that's where if rates feel too high today and people are waiting maybe until rates come down to make a move into the market, what do you say to all those folks? Because there are many of them.
Oh, they're waiting. And I don't blame them. I would kind of be the same way. If my son's looking right now, it's like rates are high. But here's the point. And I would ask you this question. Do you think if rates went back to 5%, it would spur more people to buy?
Absolutely, I do.
Okay. Your comment, I didn't prompt it, is the majority out there. Okay. So there is a demand for housing, but just maybe not at this cycle or right there in this time frame. But again, you have to look at, if you were to buy. So now let's say you don't do anything and you put it off, like a lot of the crash people have been saying, the market's going to crash in 2021 and then 2022, 2023. Now they're staying in 2024. And if you look back, and this is independent of your market, Has your market crashed to the point you're like, whew, I'm glad I didn't buy? Or have house prices still continue to move up a little bit? And, can you afford that payment now and so forth? So that'll be the determinant of per person, should you, can you or should you buy now or not? That's an individual decision. So that's what we do, something a little bit different. I won't self-promote us, but I always, if you watch any of my videos, I call myself a mortgage advisor, not a loan officer. And the reason why I do that is I don't want people to think of me as a loan officer. I want to help. I want to be a mortgage advisor because I want to be part of your decision from the day you kind of think, oh, can I buy a house? To the day you get the keys in your hand. Some people don't qualify. Some people I might go back and say, you don't qualify today and you got a massive amount of debt. Pay down that debt, do what you got to do. But, again, the way you have to look at this, and most people don't, is where do you want to be in 5 years, 10 years, not where do you want to be in 6 months? Because you're not going to buy a house today. And, in some parts of California you can, but you're not going to be, buy a house today and in 6 months, you're being the money. I got $20,000 equity in my house. It's not going to happen really much anymore. We
Right.
ran through that gamut back during COVID, and now we're just trying to find that equilibrium in the market of, but on my side of the equation, I'll tell you, we had, that the rates kind of dropped quite a bit in the last week or two. Our call count, because when people put in an application with us, we automatically schedule a consultation with them because we want to know the story. I got guys booked up all weekend, this weekend, and every call is, we got 3 people on these calls. They're every half hour on the hour from basically 8 in the morning to 4 at night. And I got 3 guys that are completely booked for the whole weekend. So that'll tell you it wasn't booked last week and it wasn't booked the week before. So that tells you what's going on behind the scenes. So now you have all these people jumping into the market. What's going to happen to prices? Again, you have all these buyers looking and the prices are going to go up. So I'm not saying prices are going to continue to go up. I'm not saying prices are going to go down or crash. I'm just saying the psyche with people right now is, and I talk to a lot of realtors, they're like, if people can afford that payment, they're buying. And, so that's my take. Yes, I'm in the mortgage business. I'm in the real estate business. I'll be transparent in this way too. I don't really care if housing prices crash. Your question might be, well, why wouldn't you? You're in the mortgage business. I probably would be a lot busier if the market crashed 20, 30, 40%. Yeah. Everybody and their mother would be jumping in buying these houses. So right. I would love a crash, for people that haven't bought yet, but for the people that own houses, that's not a good deal. But I'm just telling you, that's the kind of background of all that. So hopefully I answered your question on there.
No, that's great, Dan. That's great. So I'm curious, Dan, to hear from your perspective when it comes specifically to refinancing. Mm-hmm. So we kind of touched on the purchase side. Let's talk about refinancing. Yeah. I'm similar to you in that I bought a house during COVID at 2.875 on a 30-year fixed. I'm planning to never, ever, ever, ever touch that mortgage.
Yeah.
Now, I also have a 6.5% 30-year fix on the new primary that we bought in October.
Got it.
Looking to refi that as soon as possible.
Mm-hmm.
What should people be thinking about if they're going to refinance, how and when to refinance? What's just walk us through what needs to be on people's radar. Put on your advisor hat.
Sure. Wednesday we held a live event, and Kyle Seagraves of Win the House You Love, him and I work together. And he was like, dude, there's going to be nobody on this live event because it was a refinance. And I'm like, let's just do it. You might be surprised. We had our biggest live event ever. Because people want to know this answer. So the rule of I just did a video this morning too, so it's right fresh in my head. So I'm going to answer it this way. The rule of thumb, I'll ask you a question because I want a little participation here, and there's a reason for it. What in your mind, have you ever heard? What's the rule of thumb that you need to? How far down does your rate have to go for it to make sense? Have you ever heard?
So for me, it's all about cost. Like if there was zero cost to do it, I would do it if the rates dropped a tenth of a percent.
Got it.
Because that would be saving money.
If you just Google it or just ask somebody, the normal common answer is it has to drop 1% to make sense. And then you Google it, and one says maybe 0.5%. Then another one says 0.25%. I even went on one today, and it said 2%. Why I know this because I just did a video on this.
Yeah.
So I'll answer it this way, kind of like you did. But what you have to be cautious of is there's a lot of people out there that are ready to just screw you over. And here's what I mean. You're going to get mailers and emails and stuff like that saying, hey, it's a great time to refinance. Look, you're at 7.25 right now. We can get you 4.99. No, don't worry about the costs. There's no closing costs out of your pocket. So let's get this done. And you're like, okay, well, shit, that sounds like a good deal. So you get the paperwork. And then if you pay attention, you'll look through and it's like 5.99. He said no costs. Well, no, they said no cost out of your pocket. Okay. But you look through this loan estimate and there's $5,000 in bullshit fees. Mm-hmm. Well, that doesn't make any sense. So you have to be cognizant of what you're getting into. So please watch you hit it on the button. What are the fees? So there's people that all week that've been asking me, Dan, should I refinance? I'm like, where do you live? I want to figure out what your title fees are. Because for example, in California, your fees might be $2,000. Here in Illinois, I can do a refinance for $700 on title. And then if you you don't need an appraisal, basically the only fees you're going to have is a $700 title fee and then setting up your escrow and things like that, because we don't charge you a fee. So, so what I'm getting at, let's move forward on some other numbers. Let's say, for example, you have $1 million loan. So every 0.25% reduction is going to save you a decent amount of money. Okay. Yeah. But if you owe an $80,000 loan, a 0.25% adjustment in the rate isn't going to do shit. So I would highly see, I tell people all the time, don't refinance, wait, let rates come down, pay down your mortgage a little bit. I make money by doing the loan, but I want to sleep at night too. So I'm not here to take advantage of anybody. I'm here to, like we're doing on this video, my whole goal with everything is explaining the whys behind it. So you have to really go to a mortgage calculator, refinance. And I just posted one on my video this morning. If you guys want to check out my videos and check out the thing, just plug the numbers in. If you want to know from me or any other loan person, check and see what their fees are. And your fees are going to be basically title appraisal. And it's much easier to get approved for refinance than it does when you're trying to buy the first house. Because when you bought your first house, they want your firstborn, secondborn, DNA samples, stool samples, all this other stuff. Right. It's hard. Most mortgages, you're going to need one pay stub, a W-2, and an appraisal. Some, if you're in an FHA or a VA or USDA loan, they have what called streamlined refinances. You don't need anything. We don't need to revalidate your income. We don't need a new appraisal. All we do is pull a mortgage-only credit report on you. As long as your credit scores are high enough and you haven't missed a payment in the last 12 years, you qualify. So we do a lot of those, or we've done a lot of those in the past. Over the last couple of years, we really haven't done many refinances, but now that gate's starting to open, especially this week when everything's in the forefront of talking about interest rates. So the bottom line, when it comes down, please be careful who you're working with, what you're working with. Check all the dotted lines. I was quoted in Yahoo Finance years ago on a comment I made, and it was this. I said, gas prices right now are like $4. Okay. But I said, people call me every day telling me, Dan, somebody's quoting me a rate at $4.99. Well, it'd be like me telling you I can get gas today for 99 cents. Okay. Can you? Yeah. But I had to go and buy, 4 cases of beer, 3 cartons of cigarettes, a pizza and a hot dog, and a car wash, and I can get 99 cents. So you get where I'm going with this? Right. Be careful, because, a lot of this stuff is marketing and you can get really taken advantage of. But, use a mortgage calculator, figure out what your savings would be, but please reach out to either me or some mortgage company, figure out what your costs are going to be, what your real costs are going to be. That's going to be a huge deciding factor in this, because like you said, if it doesn't cost you anything, do it every time the rates drop 1/4 or 0.5%. I wouldn't advise that, but you get where I'm going. But if you're saving $100, but it's going to cost you $8,000 to do it, you probably might not want to do it. So there's a lot of pieces of the puzzle you have to analyze when you're trying to answer that question.
Yeah, no, I think that's great advice. And kind of in that same vein, as people are looking to start refinancing, as rates hopefully come down, or even make a purchase, what are some things they should be looking for in a mortgage lender, in a mortgage partner? And what are some maybe red flags they can be looking out for?
I hear a lot of horror stories, and I get a lot of scenarios past me where I'm like, it'll never work. And then people don't take my advice, so they go with another company, They get all the way to a week before closing, and then find out they don't qualify. And I'm like, I told you that, 2 months ago. You have to know who you're working with. So check your reviews and check things like that. Here's one thing I would highly suggest you not concern yourself about. We get this a lot where it's like, oh, those are YouTube guys and they're in Chicago. I need somebody local because, if I have a problem or something. Well, if you have a problem, you're probably not going to drive down to your mortgage broker shop to yell at the guys, or
Right.
You're going to text them, call them, or email them. So it doesn't matter if I'm in Chicago or whatever. You have to, the company has to be a solid company. You have to know who you're working with. That's the biggest thing. You can work with the best company in the world, but you're stuck with somebody who just doesn't know any better. Like a lot of the bigger companies, like Rocket and Guaranteed Rate and things like, I don't know about Guaranteed Rate or so, but you call in and I'm not making this up. Normally the people that are taking those calls are new to the business. So they're just sales. They're just, there's a marketing room and they're just answering, they're answering the phone and just, doing the best they can. They don't know a lot. So they might put you into a program maybe you shouldn't be in. They might, think that they can do your loan and can't do your loan. They might be able to do your loan and not be able to structure it to get it done. So you have to know who you're working with. That's why I post a video every day, just explaining to people what's going on, how things can be done. And hopefully with my credibility, they're like, okay, this guy's pretty good. And you can check out Google reviews. But, the biggest thing is you have to know who you're working with. That's the best thing. It's, again, you can work with the best company, but if the person you're working with is terrible, your whole experience is going to be terrible. So please, pay attention to all the don't be taken. You want to know what your costs are and your rate is. Because a lot of companies will also, I can't give that to you today, or we can't do that. That's red flags, is when they, start avoiding you, or they won't send you like an analysis of your costs or anything. I don't care. You're going to see them eventually anyways. Sometimes I lose because I'll put in there, my costs are truly what my costs are. And then somebody else will put in, let's say their title fees, they'll just make up a number saying, our title fees are $100. And I know they're going to be $1,200. So I put on my disclosures, it's $1,200. They put on their disclosures, it's $100. So who's going to win? They're going to show that they have lower fees than me. But when it comes down to the closing, you're going to have that $1,200 title fee. So you got to trust who you're working.
Yeah, that's great.
How do you find
Dan,
those people? I don't know. And that's why I do what I do. So help people, help me get exposed to people who need help.
Yeah, that's great. And I'm just curious, and for everyone listening, like how many mortgages did you do last year?
I average about 13 a month, me.
Okay.
So I still do, I do, but I have a team as well out here. So I got 4 other loan officers. And last year was brutal, based on transactions. And that's why I said previously, I'm like, I would love a crash. Our transaction count would go skyrocketing, but it's not good for the country. It's not going to happen. You might see the poster child of, everybody posts these videos and Miami's terrible. Okay, well, don't buy in Miami. You know what I mean?
Right.
Or, Austin is horrible. Well, don't buy in Austin. But there's still 50,000 other big cities in the country that you can move to. So that's my take on it.
Pick one of those.
Yeah. Sorry, just being blunt sometimes.
No, that's great. That's
cool.
Great. Well, Dan, this was super fun, man. Thank you so much for sharing your wisdom and the background. Hopefully everybody listening got something out of this. If people want to find out more from you, reach out to you, get a loan from you, follow you on YouTube, where's the best place for them to do
Honestly,
all that?
Just Google my name, and my name is Dan Frio, and you'll find out everything and more about me. And you should find pages and pages of things about me. Hopefully you like what you see.
Awesome. Well, hey, thanks again, man. Sure appreciate it. And we'll catch up soon, I'm sure.
All right, dude. Take care. See ya.
You too. Bye. Well, that was our show, everybody. A big thank you to Dan for coming on and sharing a wealth of knowledge with us. Again, if you are thinking about even contemplating about thinking about a refinance, definitely give this episode another listen and reach out to Dan. He might be able to help you out. We look forward to seeing you on the next one. Happy investing.